As we prepare for a new trading week, the technical table has been set for more upside in stocks. The potential is there. The bulls took the 50-day moving average back. They also took 1640 back on the S&P 500, which was a key level. This is the title slide from last week's video where we noted that the bulls needed to take the 50-day in 1640 and that flexibility was required. If we failed here, we needed to keep an open mind about downside, and as long as we remain below 1640, somewhat of a fence-sitting neutral stance or tentative stance was required. We've been scaling back into the markets. Both of these things the bulls needed to have happen have happened. The key to being successful in the stock market is to pay attention to what is happening. The key is and make allocation adjustments as needed. Stock market looked very weak as of the close on Monday, June 24th. What happened after that was it began to improve. So over the last 3 weeks, the is happening was improvement, and as the market improved in this week's video, we'll show you why and how we scaled back into the markets and what the markets are telling us now. To view the video in full screen mode, use this icon in the lower right hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right hand corner of your video player. This is a weekly chart of the NASDAQ Composite Index. This chart contains 2 inputs to the CCM market model, the 22-week moving average in blue, and Williams percent R, which is a measure of momentum. Again, this is a weekly chart that we're looking at. The way the models work, Williams percent R, as long as it's above the upper line of -20 over here to the right, good things tend to happen. Not too many bad things happen as long as Williams percent R is above that upper line of -20. Once it drops below -20 on a weekly closing basis, here the odds of bad things happening increase. Drops below here in early April, the odds of bad things happening increase. Drops below here in early October 2012, the odds of bad things happening increase. Recently, we were below, hence one of the reasons why we and our models scaled away. We've now clawed our way back above -20. How do you use this? As long as this indicator stays above -20, you err on the side of remaining long. If it were to move back below -20, then we would potentially change our stance. Similar situation with the 22-week moving average. Good things tend to happen when the slope of the blue line is up. Slope turns up, good things tend to happen. Similar situation in that it's in a bullish stance currently. As long as it remains that way for that one indicator, you would err on the bullish end of the spectrum. This could potentially be a very important chart going forward. This is the long-term weekly chart that we've looked at for several weeks. Resistance back in the year 2000 for the S&P 500 weekly. Resistance twice in the year 2007, then bad things happened. Bullish breakout in 2013. Now we came back and retested this blue trend line here. It's a good sign that we held there. It's an even better sign that we're now making a higher high. That tells us to be open to significantly higher highs going forward. We don't know what's going to happen, but it definitely increases the odds of good things happening. This is another chart used in the CCM market model. This is just a weekly chart of the VIX in isolation. The questions that we ask are fairly simple. Are the slopes of these moving averages moving up or down? If they're moving up, that tells us fear is increasing, and that tends to be neutral to bearish for the stock market. When these slopes roll over, that tells you fear is receding, and that tends to be good for the stock market down here. This is the weekly S&P 500. An observation, just an anecdotal piece of evidence. You can see here the last time the VIX fell below and closed below the cluster of moving averages here on a weekly basis, the S&P 500 tacked on 127 points after that point. In late 2012, same situation. The VIX drops below the cluster of moving averages, closes below after a spike higher. And after a spike higher is important. After a spike higher. Here, spike higher, we're below. The second time that it happened, after it dropped below, the S&P 500 tacked on 215 points. So 127 points here, 215 points here. It happened again last week. We don't know what's going to happen next, but there's no question that when the VIX is below these moving averages and the moving averages roll over, the odds of being successful on the long side of the market increase. Like the chart of the NASDAQ, as long as this remains in place, it's meaningful. If the VIX pops back up above the moving averages, then it's no longer in place, and instead of adding to the models in a bullish manner, it will begin to subtract in a bearish manner. It's a daily chart of the S&P 500 index. We're looking at price here to understand how the models and indicators can help us. The concepts are you pay attention with an open mind. As long as the market and the indicators and models remain strong, you stay invested. When you start to see deterioration, you start to step away at an incremental rate. So when you get down here, we're in 50% cash managing risk. How do you step back into the market? You pay attention with an open mind, and when the models and the indicators start to improve, you start to scale back in at an incremental rate. On Short Takes, our blog, on Friday, July 12th, we have a post that shows some timestamp tweets from Twitter, where we basically show from June 27th all the way back till June 11th, where the models were telling us to step back in as the market improved. How do we know to do that? This is the CCM correlation model, which is one of the 5 sub-models used in the master CCM market model. This is June 24th here. This is where the market makes an intraday low. The correlation model is measured on a scale of 0 to 100, with 100 being the highest possible score. So from a technical perspective, on June 24th at the close, the market was extremely weak with a score of roughly 17 or 16. You can see the market technically started to improve as we move back towards the present day, and the scores start to increase. That tells us to start increasing our exposure to risk. The score on Friday, June 12th at the close was all the way back up to a very respectable and healthy 84. What does this number tell us? And what does this number tell us? And how does it help us? And how would we use it going forward? Now we have a very respectable score of 84. Well, as long as the scores, which are based on technicals and observable evidence of the stock market's health or lack thereof, as long as the scores remain in a respectable range, you remain invested. If the technicals start to deteriorate, you start to step away. Why do you step away? Well, we don't know if the market is going to make a low on June 24th. It's possible that the peak on May 22nd was the beginning of a 2-year bear market. So you step away, manage risk, you wait for evidence that the market is starting to improve. And just like we looked at the chart of the NASDAQ and we said, we can look at Williams percent R and say when it's above that upper negative 20 line, not too many bad things happen. When the slope of the 22-week moving average is up, not too many bad things happen. Well, you can ask literally hundreds of questions like that can help you determine the health of the market and what the probabilistic outlook looks like. This is what we do every day. These are all questions that are being answered. On the weekly chart of the QQQs, is RSI rising or overbought, yes or no? You can see how detailed this is. It'd be nearly impossible for any one of us, myself included, to look at this manually and make all these decisions. There's also mathematical inputs where we look at the levels of indicators and ask, where does this typically happen? How healthy is a market that has a CCI of 116? You take all of this data and the questions that we answered, and you calculate where the market is today, and it allows us to compare it to historical scores. And you can see how detailed this is. It would be nearly impossible for any one of us to manually look at charts and take all of this information and boil it down manually to one number that we can make decisions from. This is a chart we've reviewed in the past, just an update to it. You've got the 50-day moving average for the S&P 500 daily here in green. The red is the 40-day exponential moving average here. The blue is the 20-day exponential moving average. The pink is the 200. And this is the 390-day moving average, helping us monitor longer-term trends. Point of the exercise, not too many bad things happen when price is above the moving averages and their slopes are positive. Not too many good things happen, or the odds are not in your favor when price is below the moving averages and their slopes are down. You can see things look pretty shaky here. Now we look a lot better. Price above the moving averages and the slopes turning back up. How useful is this? One of the inputs for the master CCM market model is based on these moving averages here for the most part. Almost 90% of the output is based on asking questions about these moving averages. And let's take a look at historically how much value something as simple as moving averages, slopes, and price can add to our decision-making process. This is one of the spreadsheets from our massive backtesting project where we backtested our rules and models going back to the beginning of 2003. The master CCM market model is diversified in that it has 5 different models that provide input. There's the correlation model that we looked at earlier in an Excel spreadsheet. There's an override model that's based primarily on the moving averages we just looked at. There's a step out model, a step in model, and a risk model. Point of the exercise here, if we run the back test simply using the override model, are making decisions just based upon the moving averages that we just looked at, that model alone beats the S&P 500. This is making decisions based on that simple model. This is the S&P 500 here. You can see the average annual return using just the override model is almost 12%. If I held SPY, the ETF, didn't trade it, didn't pay any fees, I'd have made roughly 9% a year. But look at the drawdowns. Your drawdown using a simple model like this that we built is roughly 9%, and for the S&P 500, it's 55% roughly if you held SPY from the peak in 2007 to the trough in March of 2009. Chart 1 of the CCM Big Four. These 4 charts are all used in the CCM market model. S&P 500 weekly in isolation with the moving averages here. A bullish look is price above blue, above red, with the slopes going up. You can see we've now converted from a concerning look, this is concerning, this looks more like this or this, back to a bullish look. As long as this look remains in place, we'll err on being on the long side of the market. This is chart 2 of the CCM Big Four, where we look at being long relative to being short. This is what risk on looks like. This is what risk off looks like. Everything that we said about the weekly chart of the S&P 500 applies to this chart. Looked concerning, now has moved back into a bullish stance. This is chart 3 of the CCM Big Four used in the CCM market model. Now we're looking at risk on stocks relative to risk off, or the aggregate bond ETF AGG. This is what risk on looks like. This is what risk off looks like. We said weeks ago that how this was resolved could be very telling. It's been resolved in a bullish manner, and it has been very telling. Since this resolution, the stock market has tacked on 120 points since the low on June 24th. This is chart 4 of the CCM Big Four charts used in the CCM market model. This is risk on JNK or riskier bonds relative to more conservative or risk off TLT long-term treasuries. This is what risk off looks like. This is the stock market. Risk off, stock market. You can see this chart has remained healthy since the lows made in April of this year. It looked healthy. It remains healthy. As long as it looks like this, it will add in a bullish manner to our models. If it flips over like this, it will begin to subtract. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.